Hi, this is Jeffrey Cohen. I'm here to talk to you today about Chicago Quantum. It is Monday, December 14th. First off, I want to wish everyone happy Hanukkah. And we do celebrate. Got my kippah on underneath my headset there. You like that? And I just want to talk a little bit about our business, about our models, what we're working on, update R&D. I'm going to keep my eyes open on the AMA so you guys can chat me, and I'm glad to take any questions. AMA, ask me anything. And so just a good conversation, right? So we're gonna pick up the pace a little bit. So first off, happy Hanukkah. We've been lighting candles as a family. It's been nice. We're working really hard to make sure that we're celebrating the holiday season because, given 2021, maybe it's not so easy to celebrate. And so we're finding ways to do it. We actually bought little Christmas mailboxes, and you put a gift in the mailbox, you put the little flag up, and so this way you got something. So that's kind of fun. So happy Hanukkah, happy holidays. What's interesting is the holidays does not mean that the markets are not moving. And so one of the things just to show you is, before we had the Chicago Quantum Net Score, the way we would look for stocks to buy. Right? This is not something I recommend. I mean, I've done it in the past. It's very risky. Is you put out screeners and you say, all right, show me some stocks that have gone up today. Maybe I want to buy in. Big Rock Partners, up 86%. Arvinas Incorporated, up 86%. BioCardia, Veru, all household names, of course. So it's going to take me like a week to dig in, to do some research on the company and try to figure out whether it's a good stock or not. By then, the move's already done. I have another screener I like, which has given me good things to tweet about, which is stocks that drop a lot. So I can go in and I can look for stocks. So I'm in Yahoo, Save Screeners, US and Canada. I could pull out Canada, but I like the Canadians. Love them, actually. Great people. So we're going to take stocks that have dropped less than 9%. That's crazy. So less than 8% intraday. So the stock has dropped 8%. Market cap. This is not a very big market cap setting. This is $300,000. We'll make it $3 million. $30 million. All right. And I don't want a lot of crazy stocks. So I'm going to put in here, the price has to be over $1. All right, let's see. So I go down and I see what's dropping today. Oh, look, Airbnb. I guess it didn't do that well. So we start off with Airpo Pharma down 47%. I mean, I like to buy at a discount, right? I could get Whitehorse Gold Corporation. By the way, GLSI went through the roof recently, and now it's brought back down. I think that was a pump and dump. But, here's one that gets on my list, AMC. I like the movies. I look at the 52-week spread. It goes from $2 to $9. It's trading at $3. We're going to hold that one aside. We're going to do some research on that one. Virgin Galactic Holdings. I'm not a space guy, but sounds interesting. I knew a woman CEO of a space company. It's a pretty interesting business. You have to be pretty smart to send a rocket up into space. I think they had a rocket blow up on Friday, which is why that's always bad, especially if there's going to be people in them. Thank God there was no people in this one, so that's very helpful. So, you kind of look down the list and you see what's buying and what's selling. And so, at least there we got AMC. And then you can look at AMC, just to show you some nice history on how to do this. So we look at the profile. This is actually what I do. The first thing I look at is, why is the president of AMC making $3.2 million? I gotta tell you, in the time of COVID, $1 million. And the three senior executives are all making just under $1 million. Now you know that they're probably getting extra money, right? So, all right, what's going on here? They have theaters. They have 1,000 theaters. So what's the company worth for 1,000 theaters? What am I getting here? So for 1,000 theaters, total debt. Don't forget your debt, because it's debt plus equity. So the first thing I get is I get total debt of 10 billion. All right, so 10 billion plus, let's see what the company's worth. 10.5 billion. So for 10.5 billion, I got 1,000 theaters. $10.5 million a theater. That's actually not that much money. I figure I can make 10 million bucks running a big theater. I don't know. Maybe net present value, that could be tough. Maybe it's $1 million a year in profit. All right, tough number, but reasonable. So you could start looking at it, and you can start to say, okay, if I go to the profile, I can look for significant events. Here's a material definitive event. So what did they do? Did they sell some theaters? Did they buy some theaters? They entered into an equity distribution agreement with Goldman Sachs and B. Riley Securities sales agents. They're going to sell up to 178 million shares. They get a commission of 2.5%. That doesn't sound good. So they're going to raise money, 178 million shares, $3 a share. So let's call that $500 million raised. They're going to spend $15 million, $10 million to Goldman Sachs. I'm sure Goldman needs the money, but I'm thinking AMC needs the money more than Goldman. And yeah, you know, I get a $3 million paycheck. Sure, I'm happy to give Goldman Sachs 10, 15 million bucks to help me raise money versus doing a roadshow, getting your PowerPoint out and telling the story. So, not feeling great about AMC. 10 million bucks, $10.5 billion to get 1,000 movie theaters, but it's worth watching. If we look at the 1 month view, it was trading at 3.25. It's back at 3.25. If we look for a year, we see the thing was, before COVID was at 7, dropped to 70. It's really not dropped that much, but it's not strong. So this is complicated. I got to dig into each of these companies, and then God help me if I were to buy like a Party City. Let's see if I have that one open here. Let's say I put Party City at the same time as I buy AMC. I'm concerned. My guess is something bad's going to happen, right? So let's say, I got Party City right there. So I'm getting Party City and AMC, and the stocks move in the same way. So generally, it's a little bit of a fluctuation, but generally speaking, I'm in bed with both of those stocks. I am exposed to the same risks. So why would I buy both? It could be because AMC is going to do a knuckleheaded move, raise $500 million without having to borrow. The whole company's only worth $500 million, so what are they even doing? The whole equity. And they're diluting equity by half, right? So they make a knuckleheaded move. The stock drops 13, 14%. At least I didn't get the same move at Party City. But generally speaking, I was buying the same risk. So why would I buy two? And that's what made me think about it. So what would counter Party City? What moves differently than Party City? Well, my guess is Party City is like a... Well, let's put an oil company in there. Let's put Exxon. Make it big. Make it bold. How does Exxon move? Well, Exxon's not moving much. And actually looks pretty correlated. So Exxon's not going to help me here either. And so I need to find companies that I can hold together that have offsetting risks. Maybe a bank. Let's take a look. What's a big bank? Wells Fargo. Nah. Citibank. God, I love Citibank. You know, I've been a Citibank client since the 1980s. Yeah, I'm that old. It's a little different. It's a little different. It's not that different, though. I still feel like I'm buying not exactly the same risk. See, this one dipped, but this one dipped. I don't know. So I guess I could be here all day looking for stocks that zig while others zag. And I guess that's what most people do. You know what? I could look for real dogs, real losers. I could look for Rolls Royce. Rolls Royce, the aerospace business, right? I'm looking at this stock. This thing dropped through the floor. But the reason for that is that people aren't buying aircraft engines. They're not flying their airplanes as often. There aren't as many things to do. So maybe I can put Party City with Rolls Royce. Right. Okay, maybe. But that's, you see what I mean? I feel like I'm random here. Let's look for my Almaden Minerals. By the way, their number one holding. They have two holdings. One of them is a mine that's worth $1. So that's not a big driver, their business. And the other is a Mexican gold and silver mine that they want to explore. They discovered it like 10 years ago. It cost $174 million to develop, according to a prospectus they put together, mining report. But yeah, I don't know. I'm not feeling it. This stock doesn't move very much. You have to kind of know the oil and gas, not the oil, the gold and silver business. I feel like I'm a wildcatter going crazy with the explorations. So I'm not buying this either. You could bet on companies that are close to bankruptcy. It's always an interesting idea. Sundance Energy, if you don't know any better, you could look at it and say, oh, it was $20 up here. Now it's $2. Must be a discount. I'm going to Dollar Tree and I'm going to buy myself a discounted stock. Look, it tried to break out. $5, $5, $4, $5, right? But the truth is, they defaulted on one of their covenants, and I'll explain what happened with Sundance. They defaulted on one of their banking covenants, and that caused a cross default. And so right now, they are in default, I believe, on all of their lending, all their borrowings. And so those funding companies, and they've hired Houlihan Lokey to figure out what they're going to do about it. They could throw these guys into bankruptcy at any time, which drops the stock effectively to zero. So do I really want to invest $1.94? Maybe I'm going to make zero. I'm really investing then in the ability of the company to stay in business. I don't know how I'm feeling about that. That doesn't feel very good to me. And so here's how you know. So you look at the profile. Again, this is big because you look at the you're looking at filings that they had with the Securities and Exchange Commission. The reason this is important is these are legal. These are important. So by the way, just from my earlier comment, this company not doing great. They earn $500,000, $400,000. It feels a little better. Right? They're not milking the company when the company's on the edge of bankruptcy. So we'll take a look. They did an 8K, right? Other events. As previously indicated in its quarterly report, Form 10Q, the company was not in compliance with its asset coverage ratio for its second lien term loan facility on the debt to EBITDA ratio or the minimum current ratio. Therefore, cross defaults under each facility were triggered. Okay, that's not good. That's not good. When you hear that, you hear big problems. They have to renegotiate their financing. So what does it mean, EBITDA and current ratio and all that stuff? What does that even mean, right? So most people, they didn't get an MBA. They don't have partway through a PhD. They're regular people, right? They don't know from this stuff. So let's take a look. So look at my total assets. In 16 and 17, it was like 400 or 500 million. And Then it went up to 800 million. So I'm feeling pretty good about that. The company's got more assets, right? Total market cap, total capitalization, right? 300, 400,000, 400,000. This is actually 400 million. 700 million, 700 million. Oh, wow, it's great. Now I look at my total debt, right? It went 188 million, 189 million to 300 million to 378 million. I'm not so worried because they increased their assets so much. But the net debt is rising, 170 million, 180 million, 300 million, 340. So what's going on, right? What happened? So I look at my total assets, and I look at my current assets of $48 million. That means, reasonably speaking, if they had to raise money this quarter without going to the banks, assets, and I need to pay, what do I have in my wallet that I can reasonably pay this quarter? I got 48 million bucks. Now, I wish I had 48 million bucks in my wallet. I got a receipt, and I got a deputy registrar card. So if anyone needs to get registered to vote here in Illinois, I got you covered. But my wallet doesn't have 48 million in it. It has 0 in it, right? Let's take a look at the liabilities now. Current liabilities, 70 million, 80 million. So, not bad, but the problem here is that my current liabilities exceed my current assets. So, I can't really pay my bills right now. I can't do it. I've got to do something, right? So maybe I'm going to generate cash flow from operations. That would be helpful. If I could generate that 40, 50 million. So the good news is they are generating 60 million from cash flow from operations. They're investing cash flow. They're going down. So they are investing in their oil wells. Financing cash flow went up a little. They really raised a lot of money in 2018. And they got $2.5 million of cash on hand. That's rough. That's not a lot of cash to pay all this debt. And so I'm thinking to myself that these guys, if they've got to make capital expenditures of 90 million for the year, and they've got to pay back debt or even just short-term liabilities, they may not make it. They're a bankruptcy risk. That's how I know. So, okay, got that. I could look at other stocks. By the way, this is one that I learned a lot about recently. I was talking to a buddy of mine. He happens to be a member of Chicago Quantum. And he said, Jeff, you got to check out this Oasis stock. It's crazy. It's like an oasis in the desert. You know, if I would have invested $100 in Oasis stock at 12 cents, the next day it opened and it was as high as $32 a share, I'd have been a millionaire, Jeff. If I would have put my life savings at 7 cents, 10 cents, I'd have been able to buy Texas. You know, the problem is if you would have put your life savings in at 7 cents or 10 cents, you'd have had nothing. You'd have been on the unemployment line and getting welfare checks because the stock went bankrupt and it liquidated. And the stock went to zero. And a new stock, brand new stock came in, right? Opened at $27.15 and it started trading. Old shareholders were wiped out. New shareholders, that's not bad. So the reason I point this out isn't to say, please, please, please be careful about investing in stocks that are in bankruptcy. Because at some point you might have made a penny. You might have felt good. You got in and out. Look at that. 11 cents, 12 cents. Somebody made a penny. But truthfully, they lost it all on the last day. And they weren't sure when the last day was going to be. And so it's a game of musical chairs, and there's no chairs. So as long as the music's playing, you might make a penny. Music stops, there's no chairs. No one sits down. So, but I looked at it because our model picked up Oasis as being a high skewness stock, as being leptokurtic, because the same stock went from 12 cents to $30. So what I realize is we need a way to take those stocks out of our financial analysis. It may have to be an errata type of a thing, or I'd love to be able to find a good list of that, because That's crazy, right? Same name, but it's a different stock. And so there's other stocks you can look at, right? You can look at Red Robin, gourmet burgers, and you can counter it with Synopsys. And you see, this is interesting, right? As Red Robin gourmet burger goes up, Synopsys goes down. As Synopsys is flat, Red Robin is moving like crazy. And you can see here, while Red Robin fell on the floor, because the vaccine talks didn't go so well, this is over just a couple of days, Synopsys actually went up. Those 5 days. Look at it over a month. It's less telling. Let's look at it over a year. Look at that. So, boom, Red Robin dropped to the floor in March, and Synopsys fell a little. Synopsys climbs with some peaks at the same time that Red Robin dips. So peaks and troughs are offsetting. So I look at Red Robin and I look at Synopsys, and I don't really know about these companies very much. But what I do know is that if I want to hold risk and I want to have an offsetting risk so that one bad day doesn't wipe me out, I probably want to put these two stocks together and maybe a few others and have a nice high volatility ability to make money if the market runs, right? If the vaccine comes and it works great, then I make money basically both ways, always. And so that's why we spend a lot of time looking for investments that zig when the others zag, that move in an offsetting way, so that we can still make the market beta exposure return, but we dampen some of the losses with offsetting moves without giving up our beta exposure. Wow, if I can only write that easily and put it on the website, I think I'd sell a lot more analyses. So what have we been up to? Where are we? So first thing I'm going to do is I'm going to show you where we are in ResearchGate. We've been pretty prolific. I had someone ask me today, a senior executive, pretty well-to-do guy. He said, Jeff, so are you putting like an IP moat around your business? Are you protecting your intellectual property? I said, well, yes and no. I said, from an engineering perspective, it's really hard to do this data analytics stuff. And so we have a moat because it's hard to do it, right? Hard to do this data analytics. You have to be a real specialist. On the other hand, we publish all of our algorithms. And we've published all of our data solvers. And we've published how to run them and how to do it. And in fact, our latest publication at the end of October, which, by the way, came out November 4th, which was election day, so we took a little bit of a hit. It's got 813 reads. That was the first time we'd gone over 3,000 stocks. That's a big deal. That's a really big deal. We've got a recommendation. People are out looking at it. I think it's pretty cool. If you go back to our first paper, which was 40 stocks, God, I feel like we were in kindergarten, right? We used a quantum computer to pick a 40, basically go through a 40 stock portfolio and run our algorithm. 263 reads, but 7 recommendations, and actually 3 citations. If you look in Google, you'll see we've been cited in a number of important works. Our 60 stock paper is almost 1,000 reads. Yahoo. Oh, come on. You know, you say the word Google and your phone answers you. It's weird. So we put our stuff out there. It's pretty cool. What I want to talk about is, so you could read our work, right? We have a website. I don't know if you guys know that, chicagoquantum.com. If you go to the website, we are a quantum-focused consultancy headquartered in Highland Park, Illinois. And we help people, right? We're an America, pretty much North America-centric business, but we will work with European clients. We work with allies of the United States. Our research is found here. We are founding member applicants to the Quantum Economic Development Consortium, which was set up through the National Quantum Initiative in the United States. We're very active in that activity. We go to plenary sessions. We talk to the guys who run it. It's a good organization, SRI that runs it. And we actually are registered with the federal government to do work. We're out there, right? Really, we're a research firm and we're a consulting firm that decided to get into U.S. stock portfolio optimization as a way to prove financial advantage for quantum computing. I found something out. You guys are going to find this hard to believe, but if I just put out a website and wrote some tweets, people didn't come to me and say, Jeff, here's $5,000. I'd like to hear your opinions on quantum computing. Nobody came to me with $500. In fact, no one came to me with 10 cents. So I realized that's not going to work. So you need something. You need a use of quantum computing that's going to add value. And so we created one. We created a portfolio optimization algorithm and platform. And so clients, our most common one is this one. For $150, we will find the stocks that zig and zag. You give us your stocks. So what happens, you can give us the dividend aristocrats, you can give us the S&P 500, top 64 stocks, you can give us the Dow 30 plus 30 of your favorite stocks. You give us wherever you want. One guy had 63 stocks in his portfolio. He just gave us those, plus some backups. And we take it, you email it to us within 24 hours, usually before market open. Give you a management report with your stock picks. And what we do is we analyze them with a classical and quantum computer, and we run the job for you, and we give you the analysis. If you're kind of wonky and like the technical stuff, we'll actually talk to you about the energy landscape of your stocks. We'll talk to you about which stocks were hard, which portfolios were hard to build. Did the genetic algorithm work well? Did the simulated bifurcator work well? Simulated annealer? How about the Monte Carlo analysis? Did the D-Wave quantum annealer work well? What worked and what didn't? Was it an easy portfolio to optimize? Or was it quite challenging? Because we've had some that we had to run a real 10 hours, different ways, just to get a definitive solution for a client. By the way, that client just did a client testimonial. Yes. And went public with the fact that we made them a boatload of money. They could probably buy a boat. They were so excited. The quote that they gave me when they first ran it was, Jeff, we spent $750 and we made that profit back in 3 minutes of trading. So thank you very much. By the way, they bought some more portfolios, made a lot of money. So it works because not because we're looking at the fundamentals. We're not building a story of, you like tasty hamburgers, so you should buy a hamburger stock. Or you like, we know management is excellent. No. We're looking at trends in the data, and we're looking for stocks that zig while others zag. So you have reduced risk while having a healthy beta exposure to the market. So you can make money. There's movement in the stocks. But you're holding the least amount of risk that you can relative to the return from that beta exposure. It's great. For $150, you can do that. Now, others, they would rather not tell us their stock picks, because let's be honest, their stock picks are their intellectual property. So what they might say is, hey, Jeff, why don't you run the big dog, New York Stock Exchange and NASDAQ and the American Exchange? I'll give you $750. And then the guy could say, look, I want 64 stocks. I want a big portfolio and I want a small portfolio. And so we can do that for him. It's great. Might say I want a 10 stock portfolio, and we will work hard to do that. You click on in. Basically, you enter your credit card information. You set up an account, and then rock and roll. And then we'll get back to you. We'll be in touch with not only with the results, but some of our clients actually get a free T-shirt. So we're happy to stay in touch, give a discussion of what we did and how it works, give them some confidence in what they're receiving to make sure they really understand it. And so, just extremely excited. And so I want to read to you, or at least talk to you about the client testimonial that we received. Amazingly happy. So this is a called certified investor, big investor, big dog. I have had the good fortune, pun intended, of having Quantum Chicago conduct a series of runs on several of my portfolio stocks in the service of learning how a CQNS, a Chicago Quantum Net Score, better informs my long-term trading thesis. So this is an investor that already invests, already has knowledge, already has a thesis on how to invest. Jeffrey has provided 3 Chicago Quantum Net Score models for me, where I provided guidance on rank prioritization of the stocks in the event of low trading or no data availability. And the results since November 30, 10 trading days out of 25 targeted in these models, on the top 4 stocks I used to test these scores. These are on actual trades. Stock 1 made 9.8%. Stock 2, 10.2%. Stock 3, 19.7%. Stock 4, 54.1%. So, while Chicago Quantum is not a financial advisor and does not provide any investing advice, they can help you learn a lot about any financial modeling or investing thesis you are using or considering. I'd recommend giving Jeffrey, that's me, a call today, and I will certainly be continuing to use CQNS modeling in concert with other models and approaches I use. So if you want to give me a call, here's my personal cell phone number. Typing it in the chat. It's 312-515-7333. I'd be glad to speak to you. I'd be glad to explain how it works, and I'd be glad to run a few jobs for you if you wanted to buy some. If you just want to look at the research, that's fine too. I believe the best way to demonstrate expertise is to share it. You share the expertise, you let people learn, you build the confidence, right, that they can do it, and then you work with them. I think it's great, personally. I think it's great. And so the other way clients can work with us, we haven't had them do it yet, but I'm excited to, is you can hire our team by the week. You describe your algorithm idea, your data, your timing, and then we'll build the code for you, and we'll give you the IP. Now, this is not a cheap service. It's $7,500 a week. But what you get is you get the output, you get the code. And then for $250 an hour, we'll just sit and talk to you in detail about the algorithm, methods, and results. And so I also want to share with you that it's not just the clients that put the money where the mouth is, but we ran a model on November 30 before market opened. And I told my wife that I'm going to invest. I'm going to do it. I'm going to put my money where my mouth is. And not just a little bit of money, but for me, a lot of money. And I will tell you that I was nervous. I'm scared. I'm like, what am I doing, right? I don't even know these companies. Laredo, Party City, Summit, mid-market, something, and FET, which is a Forum Energy Technologies. Didn't know anything about them. Oh, and then I added Sundance Energy. I'm like a Sundance kid, right? But I got in, and what you see from the thing is, against the S&P 500, it took a couple days for these stocks to really shine. They dropped first, but then they blew out. One of them never really even got up to the S&P, but that's okay. We held these 4 plus one more equal weighted, but the one really ran. And so when your stocks run, when 3 of them are above the index, you make money. And so what we do, we're not shy, is we have a Medium account, and we published, in fact, we wrote it up on December 2nd. If no one's paying for the analysis, we don't give it out right away. We wait a couple days. So on this one, we ran it. We were ready to trade November 30. December 2nd, we published. December 4th, we did a performance update. December 10th, we had exited our trades on that day, December 10, and so we right away published our results. And so We explained a lot about what we did this past weekend with the markets closed. We downloaded all current U.S. common stock tickers from NASDAQ, Q, New York Stock Exchange, and New York Stock Exchange American, Tape B. By the way, we FTP them. We data validate, we calibrate. We tried a few new things, and I explained 1, 2, 3, 4, 5. Oh my God, that's a lot of things. 6, 7, 8, 9 things. We tried some different things. We had 2 different selections that were made. And then we talked about it, right? Here they are. They had already gone up before we bought them. One of them had. But that didn't deter us. Over the past 5 days, it was interesting. Up and down. And then, over the past 1 day. And what ended up happening is we got a lot of zig and a lot of zag, where one rises and one falls. And that's what we're predicting. The counterbalance effect that minimizes losses but can also restrict gains. That's okay. Because for people that want to make money and survive another day, you got to have some offsets. You want to reduce your drawdowns. We also continue to research skewness and kurtosis, but we have no comment about our next product offering that's going to be coming out. Now, a couple of notes. One of them, SMLP, was difficult for us to trade due to lack of liquidity. In fact, there were a number of times I wanted to come in and double down on that investment. I just couldn't get my trades executed at the right price. And so our trading results were mixed. But here's what happened. So we had 2 positions in Forum. They both went up a little. It wasn't bad. We had an investment in Sundance Energy. Made a little. Party City. We had a good, healthy return. And then we doubled down. We kind of broke even. SMLP went up a few bucks. But LPI Laredo took off. And so... And Sundance Energy was added an additional run. And so this was interesting. One of the things that maybe restricted or hurt us in the percentage gains was that we kept our portfolios, our positions balanced. We bought the stocks that didn't go up very much in order to have balance with the one that was running. And so, we're working hard. We exited for a 16% return. By the way, past performance is not an indicator of future performance. There's no guarantees. We are not investment advisors. We are not investment analysts. We are not registered stockbrokers. So we're really doing this to research quantum and to understand how you can use a quantum computer to find financial advantage. And so if you want to learn more, you can go to Chicago Quantum and you can see all of our articles. We have quite a few. And I don't know if you noticed, but I wanted to share with you last Sunday, so a week ago, we ran 4,529 stocks at one time. Pre-validation. We ended up having to validate and getting rid of bad data stocks. So we ended up with 4,163 stocks. That's 1,000 more stocks than we did before. We're getting better at this. It's pretty exciting. It's a 4-minute read. I strongly recommend you jump in there, take a look. You got the November 30 where we publish the 4 stocks. And we really let it out there. We explain, we give you numbers and details on how we're doing things. So, we want you to know. So, net, where are we? And by the way, all the stock market stuff times can be very confusing. So, where are we? Number 1, and maybe I can even make this a little bigger so you can see it. I don't know if you guys like the yarmulke. I'm going to take it off now. See if I got my Bears hat. Nope. Bears won this weekend, by the way. Pretty happy about that. Bears have had a very, very tough season. Duh, Bears. Chicago Bears. Go, go, go. So what do I want to tell you? First thing I want to tell you is we continue to improve our models. We continue to bring in more stocks. By the way, engineering is so much more important when you have 4,000 stocks than when you have 40. At 40 stocks, the code could be terrible, but you're still going to get the best answer. You can almost brute force it. At 4,000 stocks, yeah, everything is really hard. The second thing is we found some nuances. Stocks that have been through bankruptcy but keep the same ticker symbol, got to get those out. When we opened up to 4,500 stocks, we also opened up the door to some funds, some publicly traded funds. Got to get those out. And I'm also noticing some interesting behavior with the Chicago Quantum Net Score. We have a Chicago CQNS Power, and some changes to the CQNS Power have some impacts. So you might be able to use it to calibrate how much beta exposure you put into a portfolio. I'm very excited about this. I'm taking a look. I'm doing some more research. We are looking at skewness and kurtosis. So skewness is actually the difference between the mean, the median, and the mode. So the difference between the median answer, which is the middle answer, versus the average answer. So if a stock is up 3% on the year, or let's say on average it goes up 0.03% every 100 days, but it had one day when it went up 1%. And what happens is it goes up 1%, and then it goes up 2, 2, 2, 1, 1, 1, negative, negative, negative. So your average return might be smaller, but you had a run up. You had an explosive burst. So stocks that fall really fast, stocks that rise really fast, tend to have non-neutral skews. They are non-normal distributions in the stock. So we were looking at it. People generally like a positive skew because they like it when the average return is higher than the kind of day-to-day return. When there's the chance of that explosive return. But I'm not sure that's something I'd want to trade on. I'm not sure that's the answer. But learning how to calculate it, learning how to develop it, learning the intuition behind it, we saw some interesting stock patterns, right? I'm starting to feel a little bit like a soothsayer, like a technical trader when I look at that stuff. I don't know that I like it. Kurtosis is different, so I don't have the same level of intuition on kurtosis, but kurtosis is the number of occurrences in a random stock price that have a lot of standard deviations. So 3 or more, let's say. So normally you would expect maybe in a normal distribution 1% of your observations to be, in the 0.5 percentile. So it's something like 66% of all of your observations should be in one standard deviation. Then it's 95% in 2 standard deviations. It's 99.6 in 3 standard deviations. So the question is, that's 4 out of 1,000 that should be outside of 3 standard deviations. 4 out of 1,000. But what if I see 6 of them in a year? That's a very high kurtosis. Now it doesn't tell me whether the kurtosis is up or down. So I could have the stock crash 6 times in a year and feel great about it. Oh, I got a big kurtosis. Or I could have the stock go up a lot, right? 6 times in a year, and I'm like, it's terrific kurtosis, right? It's explosive. But kurtosis is explosive in either direction. Now, there's a lot of nuance to it, right? Because as we ran reports and we looked at stocks that were high and low kurtosis, as well as high and low skewness, you don't always get what you expect. And so what we're trying to figure out is there some common sense intuition, like stocks that zig when others zag, that we can use with kurtosis to possibly benefit people who want to buy risk. So you could have a stock with a fairly low variance. It doesn't move much on average, right? If you look at it for 100 days, maybe it only moved less than 1% every single day. So the variance might be less than 1% move in a day. But then, boom, once or twice, you have a massive move, 10%, right? Okay. So I got high kurtosis, but I have low variance. The thing doesn't move, but then it explodes. Well, if I'm a stock option trader and I'm buying my implied volatility, and let's say implied volatility, which is Black-Scholes, it's a calculated number, it's not real. But if my real volatility is low and my implied volatility is low, and I'm thinking I'm buying a real sleeper here, so I'm selling time, I'm selling options, and I'm selling time decay, and I'm planning on just making the money without having those out of the money options be in the money. But all of a sudden I look and wow, there's some high kurtosis here. The thing explodes like once, twice, 3 times a year, more than 6 out of 1,000. Maybe it's 1 out of 10, 1 out of 100. Maybe it's whatever. Maybe it's 6 times in a year, right? So now I'm selling time. I'm out of the money. I'm thinking I'm going to retire on that time delay, time decay. But now kurtosis kicks in and I'm in the money, and now I just lost my shirt. And so we're thinking about how you'd use kurtosis possibly with a buy and hold strategy, or kurtosis with an option strategy, as well as positive skewness, which is your third moment, and kurtosis, which is your fourth moment with a buy and hold. Working on those, want to build a formula, and I really can't wait to get it on the quantum computer and see what I can do. One last update. Last week we were trying to get a big run on our quantum computer, and again, the response time was terrible. There were runs that took 14 minutes. So I just want you to imagine, when I run my simulated annealer, I might run 1,000 runs. I'm going crazy, right? Because I want to really look expansively at the whole scenario, and I want to figure out the stocks that are going to be the right stocks based on portfolio size. So when I run the quantum computer, I have to feed it a job for each portfolio size. So if I'm looking at 4,000 stocks, and let's say I'm going to run on the quantum computer 130, we were running 132 stocks on the quantum computer. So at one time, snapshot, boom, give me the best portfolio out of 132 stocks. It took 14 minutes to get 3 stocks. Then I got to run 4 stocks, then 5 stocks, then 6 stocks, and on and on and on. You can't do it if it's 14 minutes a run. I run at a time. It's got to be like 2 seconds wait time. And so what happens is when I run it on the old D-Wave system, the Chimera system, I'm getting 1 or 2 second response time. It's great. It just comes right back. But the advantage, for a while I was doing okay. When I got up at 3 in the morning to run my jobs, it ran really fast. I guess at 3 in the morning, there aren't a lot of people running on the system, except maybe in Japan. But at 3, 4 in the afternoon, just took too long. So learned something there. The other thing I learned is when you're downloading 4,000 stocks, you rely on your data provider, your market data services, market data feeds. And I had outages, little blip outages during the downloads of our data feeds. So what would happen is I'd be running 4,500 stocks. At stock 80, it would fail for a second, and I would lose a couple stocks. That means I had to throw it all out and do it again 15, 20 minutes later. So we're starting to run in at these large numbers into things like, well, maybe I've got to buy market data services. So we're not doing that today, because today we have a very low-cost offering that is right-sized for the individual investor. When I can run a quantum job for $150, and pretty much I have to pay for the quantum time. So it's not a lot of money for me, but it's okay. My wallet's empty, so I don't have to charge a lot. But if I've got to put out 20 grand a year in equity prices, and I got to put out another, let's say 40 or 50 grand a year or more, 100 grand a year in bond prices, I'm in trouble. And if I've got to buy reserved quantum time for $50,000 or whatever, now your price goes up. Now the only people that could afford to run the Chicago Quantum Net Score are the big players. That's exactly what I don't want to do. I want to keep this for now democratized, so that you folks out there that might be listening to a YouTube video might decide, you know what, I got $150. Chicago Quantum, don't let me down. These are the stocks I really believe in. Do a thorough analysis. Give me 5 or 6 stocks that I can double down on, please, and do it right, and give me a result, give me a report that makes sense to me. We'll do it because I want people to learn how to use quantum computers for financial advantage. And so that's our model. So I want to thank you for listening. I'm just going to put up a very, very short commercial advertising. Let's see if I can do this. My commercial advertisement is Finviz, is a really, really great company. By the way, we have no relationship with Finviz, but they have this great S&P 500 heat map that I got to tell you, I just love it. You can go in, you can see oil and gas is all red today. 1 day performance full. You can look at just the S&P 500. So there's fewer stocks. I love this website. And when you're done looking at them, please take a look at Chicago Quantum. www.chicagoquantum.com. We have portfolios that you can run, portfolio analyses. We have research that you can read. We have an active blog. And for some reason right now it's really slow to load, but that's okay. So there it is. Go ahead and take a look. Click on the portfolio tab and buy a portfolio. You can even spend $50 for a non-quantum portfolio choice just to get a taste, just to see what it's like. We lose money on that one, but don't worry about it. We'd like some customers. And $150 we'll run at classical and quantum, and then from $250 to $750 we'll run the big loads for you, the full exchange loads, and we'll pick the best Chicago Quantum net score that we can find for you and give it to you, most likely before market opens the next day. So again, thank you very much. Take care now. Bye bye.